going back when they're ready to these investors, some really lies, so just taking off your head.
Approximately 90 minutes and interact with me. Like with this poll right here, I want to interact with you because I can't see you and I can't hear you. And I can't also read the comments because there's way too many comments happening at one time. And my focus here is on the slides. That way we can focus on the Investor Summit. So what I will ask for you is to interact with me. And one of the ways that we're going to do that is to use the avocado emoji. So if you can start off, give me a quick avocado emoji. That way I know that this is working. Try to paste it in right here. I know it's a little bit of a stretch because you got to copy it from your chat or your text from somewhere. But give me an avocado emoji because instead of clapping, instead of, what is this called? Snaps. Give me an avocado emoji. That way I know if you agree with something, give me the avocado emoji. If you're with me, give me the avocado emoji. This will be the way that we clap. This will be the way that we snap. That way we can all be like, yes, this is what's going on. All right, we got the avocado emoji. It's a little bit delayed, so I appreciate you guys working with me. Now, for those of you who don't know, because I know a lot of you are from Market Briefs, and there are a lot of people who joined and read Market Briefs who might not know who I am. My name is JAHSPREET Singh. I am the host of the Minority Mindset Show. I'm the CEO of Briefs Media and the founder of Briefs Media. I did not grow up learning about money. In fact, I was actually actively told not to worry about money or stress about money. My parents are immigrants who stayed in India called Punjab. They came to America with very little. They wanted me to become a doctor, so much so that they told me not to do anything that isn't related to science, math, and medicine. But in the back of my mind, I saw how hard my parents were working, and I wanted to do something different, so I kind of went out of my own way. I didn't get any traditional financial education. I didn't go to business school. Actually, I wasn't smart enough to get into business school. I applied or tried to apply to get into business school, but I almost failed my economics class, so I couldn't get in. So everything that I learned is through my own education. I started investing in real estate when I was 19. I've been investing for over a decade now. I've been doing a lot of different things. And my parents, while they were not very supportive in the beginning, they were very much into this idea that if I needed to become successful, I had to go out and get some sort of professional degree. And that professional degree in my household, because it wasn't going to be medicine, was a compromise, which was I needed to go out and become an attorney. Now, I didn't ever want to work as an attorney. I did it to make my parents happy. But the interesting thing is I went through law school, I put in all the work, and then I never worked a day as an attorney. And I was very fortunate to do so because by the time I graduated law school, I had a strong portfolio of real estate properties, and I was also working on a number of different businesses. But that gives you a quick summary of who I am for those of you who might not know. And if you follow me on YouTube, our YouTube channel, The Minority Mindset, has over 150 million views right now. So thank you. A round of applause and some guac to everybody here for all of your support to help us get to where we are today. And kind of a funny little story I wanted to mention, because people like to put social proof or whatever so people know who you are. I've been getting a lot of features in Yahoo Finance, which is funny and interesting at the same time, because on one hand, I grew up reading a lot of Yahoo Finance, and now this is in the last couple of weeks, just the number of features that Yahoo Finance has put of me. I was never asked about these interviews. In fact, what's kind of funny is I'll get screenshots that people say, hey, did you say this? Or I love this interview that you did on Yahoo Finance. And the funny thing is 9 out of 10 of them, I wasn't asked about these questions. So it's kind of funny where you'll see some of these questions or articles about me, and they'll say, JAHSPREET Singh, the Canadian businessman who says this, or JAHSPREET Singh this. And I'm like, that's not even true information. So kind of an interesting thing about how news has evolved and why you definitely want to make sure you're getting your information from a reputable place, because I love Yahoo Finance, but just kind of a funny little note that I wanted to address here. Now, let's jump right in. Part one, let's lay the foundation for how our economy got to where we are today. Cool. Two of the biggest years that changed our United States economy are 1913 and 1971. And this didn't just affect the United States. These 2 years affected the entire world. Now, I'm going to ask you a quick question. Let's start with 1913. Does anybody want to guess what happened in 1913 which changed our economy forever? Anybody want to guess? And I know there's a little bit of a delay here, so give me a second as I come to read your comments. What happened in 1913 which changed the economy forever. Bretton Woods, the Depression, the Fed, income tax. Yes, I see the answer. There are two things that happened in 1913 which changed our economy forever. One is the income tax, but that's not what I want to talk about today. But rather, it is the Federal Reserve Bank was officially created and enacted as the central bank of the United States in 1913. But that by itself wasn't enough, because in 1971, we saw the second change to our economy, which really amplified the power of the Federal Reserve Bank. And that was our dollar being taken off of the gold standard. Somebody mentioned Bretton Woods. Well, in 1971, the dollar was taken off of the gold standard. So now, what does that mean? The central bank in the United States, the Federal Reserve Bank, has the ability to essentially print money. But prior to 1971, our money was actually money, meaning it was backed by physical gold, which means that if our government wanted to spend more money, it needed more wealth. What was that wealth? Physical gold in order to do so. Well, leading up to 1971, the United States owed a lot of debts to countries around the world. And countries around the world started demanding their money, aka gold or money back. And the gold deposits in the United States were being depleted. Now, to counteract this, that was where in 1971, President Richard Nixon took the dollar off of the gold standard. He did that on August 15th, 1971. Today actually marks the 52nd anniversary of that happening. So now, when the dollar got taken off of the gold standard, our money went from money to currency, essentially pieces of paper. The reason why that's so important is because, well, in 1913, the Federal Reserve Bank was also created. The Federal Reserve Bank has the ability to create money. And in 1971, the dollar was taken off the gold standard, which meant our money is now essentially pieces of paper, which means now that the Federal Reserve Bank has the ability to essentially print money on command. And can anybody guess what is the cause now? Put it in the comments. What is the cause of money being printed on command?
Inflation,
what is the impact
inflation.
of the Federal Reserve Bank being able to print money essentially on impact? Want to take a guess? It's a one-word answer. You can put it in the comments. Let's see what it is. You guys, y'all are smart. Y'all have been watching my YouTube videos, haven't you? Y'all have been paying attention. Inflation. Inflation is the impact of this. And we have been facing this impact of inflation, not just since the pandemic, but since way before the pandemic. This is something we've been dealing with for decades. Now, if we take a look at the impacts of inflation and how our economy has changed over the years, let's take a look at what has happened over the 50-year span between 1971 and 2021. And don't forget, we saw a lot of inflation after 2021. You might have seen me talk about this on YouTube, but I want to briefly go over this because in 1971, excuse me, the median household income was just over $10,000. By 2021, the median household income had grown to over $70,000. So that's about a 700% increase. Well, in 1971, if you wanted to go out and buy a new car, it would have cost you about $5,000. By 2021, $42,000 to buy a brand new car. In 1971, if you wanted to go out and buy a new home, the median home was sold for $25,200 in 1971. By 2021, the median home was selling for $464,000. By 1971, or in 1971, college tuition costed $400. By 2021, if you wanted to go to college, public four-year university, $9,300 to go to college.
Back in.
But you want to know what the real kicker is in all of this? In 1971, it was a one-income household. By 2021, we had two-income households because society changed. We went from one-income households in 1971 to being able to afford all of these things to now in 2021, median household income, which is now two incomes, to grow, but not growing fast enough to keep up with car prices or home prices or college tuition prices. So yes, household income has grown, partially because now there's two incomes working as opposed to one, but household income hasn't grown fast enough to keep up with prices of things like cars and homes and college tuition, which brings me to the question of where do you think inflation is heading? And I want you to think about this in terms of where is it heading in the next 5 years? And where's inflation heading over the next 50 years? I'm going to take a sip of water as I read some comments here. But where do you think inflation is going to be in the next 5 years and 50 years? What is it going to look like? What is household income going to look at? I want to see your comments here. I'm going to take a quick sip of water. All right. We have recession, Mars, up, stagflation, further up to the moon. Yeah, it's going to continue happening. And interestingly, I released a quick teaser video to this investor summit on Facebook, and here are just a few comments of what some people said. Brian said, inflation will be average. Inflation is like an addiction problem for our government. Every time they get into a hard situation, they print more money. Dan said, I really don't think inflation will come down that fast. Jay has said, we're printing money to solve problems, and this is continuing. Anthony says that inflation will continue to grow through time. My parents paid $28,000 for their first home in 1972. The same house is over $375,000 now. Marina says, inflation can't stay high for too long, so it'll cool down in the next 2 to 5 years. Now, the interesting thing about this is even the Federal Reserve Bank, our central bank, says that they do not want the prices of things to fall. They want to bring inflation down, which means the prices of things will continue to rise, just not as fast as they were before. That's the Federal Reserve Bank's goal. And for most of the time between the 1970s and now, inflation was at a moderate level, or at least what the Federal Reserve Bank would consider a moderate level. Yes, there were some years of higher than normal inflation, especially in the 1970s and 1980s. But on the most part, the inflation was considered moderate. And even through most of that moderate inflation, guess what? The average person struggles now because of the inflation. Because, well, between 1971 and 2021, household incomes grew by 700%, partially because there are 2 income households today as opposed to 1. Car prices grew by 840%, home prices grew by 1,800%, and tuition prices grew by 2,300%. So yes, wages have gone up. But the prices of other things have gone up even faster. This is the impact of inflation from what we've seen 1913 and 1971. And this is why it is so important to become financially educated and own assets, because our system is designed to benefit the financially educated. If you agree with me so far and you're with me, give me a couple avocados so I know you're with me. I'm going to sip another sip of water. All right, Martin says avocado. Michael says avocado. I'm going to call him guac from now on. Give me a guac. David, guac. Oscar, guac. All right, perfect. We got a lot of guacs coming in. Now, the next part of this, when we talk about wealth and we look at how wealth has changed, this is from the Pew Research Center. And this is looking at data from the early 1980s to 2016. And what it tells us is that if you look at income, different income households, upper income, middle income, lower income, between the early 1980s to the mid-2010s, what we have seen is that the higher income households have controlled a larger piece of wealth, aka assets, in the United States. And this doesn't just apply to the United States. You have similar trends around the world. Well, the middle income households have owned a smaller share of the wealth. We've seen it fall from 32% of the wealth to 17% of wealth. And the lower income households had an even smaller share of wealth, from 7% down to 4%. Now, when most people see this type of data, which shows people earning higher incomes or owning a higher share of wealth, the most common response to this is, well, I should make more money. The problem is more income without more financial education doesn't solve the problem. If you agree with me, and you don't have to agree with me here, if you agree with me, give me some guac on this one. And I'm going to show you why I'm saying this in just a second. I told you this was going to be an interactive investor summit. All right, we're starting to get the guacs come in. Some of you agree with me, and I'm sure some of you don't. But take a look at this one. This is a story that I found just a few months ago. This is it would hit the headlines in April of 2023. It was a story of a lady named Sharon who won a $10 million lottery 10 years ago. It changed her life. She was broke before. She won over $10 million and now had all the money in the world and was financially free. And then she went out and started spending the money. Well, the reason why this news broke is because she spent all that money, and now here she is today. She had to get rid of her home. She is renting a home and has to start working again. This is why more money without more financial education leads to bigger financial problems, because that more money can lead you into bigger financial holes. Because if you don't know how to use your money, well, the bank is going to get you to borrow more money because they become more credit worthy. If you don't know how to use your money, corporations are going to get you to spend your money because that's what they're in the business for. Now, again, does that mean they're bad or evil? Well, it means you need to understand how the system works. That way you can win in the economic system. And this is why, again, our system is designed to benefit the financially educated, which is why you need to become financially educated as well. Now, in our economic system, what does that mean? There are three different categories of people. There are three different types of people. I don't know what the right word for this is. I said people twice. You have the B, the I, and the C, which stands for you have businesses, the entrepreneurs that create the businesses. You have the I, the investors, which own a piece of the businesses and the assets. And then you have the consumers. And how does our economic system work? Well, economic system runs on spending, which means consumers spend money in businesses. And when consumers spend more money in businesses, that means that investors benefit because now the value of the asset grows because investors own a piece of the business. They own a piece of the profit. This is how our economic system works. But that's not all. Because don't forget what I said just a minute ago. Our system is designed to benefit the financially educated. And let's tie in what I said in the beginning of this investor summit. 1913 and 1971, these 2 years were major years in our economy because these are the 2 years that have contributed to our inflation. 1913 was when the Federal Reserve Bank was created, the central bank, which is able to print money. And 1971 was when the dollar came off of the gold standard, which meant the Fed has the ability to essentially print money on command. And so now when you have inflation, what does that mean? Let's take a look at it. When you have inflation, that means now that consumers have more ability to spend. Inflation means wages go up. Remember what we looked at between 1971 and 2021? Wages go up. And what does that mean? Well, now the prices of things also go up too. So now inflation means you have to pay more money in businesses. Consumers get hurt because now you got to spend more money at businesses. We've seen this especially in the last few years. You want to buy groceries, you want to buy guac, you want to buy clothes, you want to buy an airline ticket. It costs more money, which means businesses are getting more dollars. And it also benefits the investor because now the investors who own the assets own the piece of the economy, which is now selling for more revenue. So inflation happens. Consumers got to spend more. Businesses earn more dollars and investors own a piece of that, but that's not all. Don't forget about taxes. Remember what I said. Our economic system is designed to benefit the financially educated. And one thing that I spent a lot of time learning in law school was taxes. And let me tell you something. Our tax code is designed to benefit the business owner and the investor more than the consumer. Everybody is a consumer. Poor people, middle class people, upper class people, every single person is a consumer because when you go out and you buy a mic, you go buy some water, you go buy a laptop, you are a consumer. Every single person is a consumer. But not everybody is an investor. Not everybody is an entrepreneur. You don't have to go out and start a business, but everybody needs to be an investor. And guess what? The people
you can make as much money
who
as
are
you want.
paying
You
the
can make
highest tax rates to get in the lowest tax write-offs are the people who are only employees. If you are an investor, you automatically qualify for lower tax rates. If you are a business owner, you automatically qualify for more potential tax write-offs. So now, let's put this together. Our system runs on spending. Consumers spend money in businesses. Investors benefit because now the business is worth more. Inflation happens, consumers spend more, which benefits the businesses and also benefits the investor. And then you have the tax code, which also benefits the investor and the business owner more than the consumer, which is why you need to become at least a part of the I circle. Because if you're just a consumer, well, you are a pawn in the economic system.
Definitely, bro.
And this is why you need to invest in your financial education. All right. I know that was a lot on that, so I'm going to take a quick second. If you are with me here still, give me some guacs. That way I know you're following along.
Give me some guacs.
All right. Wow, the guacs are coming in quickly now. Looks like the lag is starting to go down. Let's keep going. So, to recap on what I just said, our system benefits the financially educated. And the reason why is because, well, number one, there's no limit to how much you can own. This is part of the wealth snowball. Because as you start using your money to buy investments, as you start using your money to buy assets, you can use your assets to buy more assets. This is part of the wealth snowball because now you're putting your money to work and that money is going to be making you more money. This is what we're talking about in part 3 of this investor summit of different ways you can put your money to work. The second part is that inflation is a part of our economic system. We talked about 1913 and 1971. It's a part of the economic system, but it benefits the investors and the business owners, not the consumers. And the third part of the economic system that you have to understand is the tax code. Because guess what? As an attorney, who's not your attorney, I can tell you that our tax code benefits investors and business owners, not the consumers, not people who just consume. So what does it mean now to be financially educated? Because I keep saying this is why you need to invest in your financial education. This is why you need to be financially educated. This is why it pays And why the economic system benefits the financially educated? Well, it means you have to be part of the investor class.
Okay.
You don't necessarily have to go out and start a business, although if you are an entrepreneur, by all means, go out and do it. But at the very least, you have to stop just being a consumer and you have to be an investor. And more particularly, what it means to be financially educated is, number one, is you have a system to create and keep your wealth. Number two is you have to know how to grow your wealth. That's what I'm going to be talking about in part 3 is how do you actually put your money to work to earn more money. And number 3 is you have to find and capitalize on opportunities, because let me tell you something. We have a lot of crazy things happening in our economy. And you want to know how you can capitalize on the things that are happening in the economy, because that's going to allow you to buy more investments at a bigger discounted price. All right. That's it for part 1. Are you ready to jump into part 2? Jay has said you're spending money to solve problems, and this is continuing to give you a quick recap as I'm waiting for the guacs to come in. Our system produces inflation. The reason why is because in 1913, the Federal Reserve Bank was created, which was a central bank here in the United States. In 1971, the dollar was taken off the gold standard, which meant now that our money became currency. Now the Federal Reserve Bank can print money essentially on command. The second thing you have to understand is inflation benefits the financially educated, and our tax code benefits the financially educated. And finally, if you want to be financially educated, that means you have to, at the very least, be a part of the I circle, the investor class. We got the guacs coming in. Oh, baby. You will probably lose money, says Zhang. Well, there are ways to limit your losses, and the goal is to make way more than you lose. All right, with that, let's go into part 2. Systemize building wealth. Now, this might not seem like rocket science, but you got to make yourself rich before you make everybody else rich. That means you got to use your money as a tool to make yourself rich before you spend all of your money. Because if you spend all of your money at Lululemon, if you spend all of your money buying the extra guac, well, guess what? You can't afford the extra guac anymore, because now all of your money is gone and you've already eaten that guac. So what does that mean? At the very least, you want to have 3 different bank accounts. And I do recommend everybody have 3 different bank accounts. And I know I can't recommend anything, but I recommend everybody at the very least having 3 different bank accounts, because you don't want to accidentally spend your investing money. Now, the reason why you want to have 3 different bank accounts is because you want to have a place to keep your spending money, your investing money, and your saving money. And if you've been following me on YouTube, you've probably heard me talk about the 75-15-10 plan. This is a very basic plan you can consider following, which essentially says that now for every dollar that you earn, 75 cents is the maximum that you can spend, 15 cents is the minimum that you invest, 10 cents is the minimum that you save. And the reason why is you're always now investing and saving your money first before you go out and spend all of your money. And this is so important because, well, most people are spending all of their money, which means they have no money left over to invest. And the reason why this is so important is because our entire economic system is designed to get you to spend your money. This is what I've been talking about in the early part of this investor summit. That's how our economic system works. You can hate it, you can love it, it really doesn't matter. My goal is for you to understand it, that way you can win in the economic system. So now when it comes to spending your money, what does that mean? That means no more financing liabilities that don't pay you. No more buying things with money that you do not have. And let me show you why this is so important. I just made a YouTube video on this, but Wells Fargo put out this report titled Home Stretch, How Untapped Equity Could Sustain the Consumer. Did you see my YouTube video talking about this?
I did.
And if you're doing 50, 30, 20, if you heard me talk about that, that's even better. But Wells Fargo talks about this untapped 50, 30, equity as a way 70, for 15, homeowners 15, to now 25, spend more money. Essentially what this 15, article said was 5, 10, 15. Homeowners have a lot of equity in their homes, part 1. Part 2 is that inflation has caused the prices of things to go up so significantly that people are struggling. And part 3 is don't put this on your credit card, pull out the cash out of your home. That way you can keep living a lifestyle and keep spending money. And this is why, again, I'll say this one more time, you do not want to keep financing your liabilities because, well, when you're sacrificing your home to keep affording the Gucci and the vacations, well, you are living in financial danger and you will never become wealthy that way. And remember what I was saying just a minute ago, that corporations and banks and everybody is spending billions and billions of dollars to get you to spend your money. Wells Fargo, one of the biggest banks in the world, you can hate them or love them, put out a whole research report saying that it's a good idea for you to pull out cash out of your home instead of going into credit card debt. And that is so risky because, well, if something happens and you cannot make the payments on your home and you go under, well, now you lose the home that you live in, as opposed to credit card debt where if something bad were to happen, you could declare bankruptcy. So that's the first part on the spending. The second part is on the saving side. You've heard me talk about you don't want to save all of your money because if you save all of your money, well, your savings are losing value to inflation. The second part is on the savings side. You've probably heard me say that. If you've heard me say that, give me some guac in the comments. You don't want to save all of your money because when you save your money, the goal isn't to just save it. The goal is to save it for an emergency, which means you want to save 3 to 12 months worth of expenses. And this is going to depend on where you are financially. If you are 22 years old and you don't have any financial responsibilities, then don't worry about saving a year's worth of expenses. If you are 35 years old and you have a family, you got some kids, you got a bunch of financial responsibilities, maybe you want 6 months, 9 months, 12 months worth of savings. I'm going to leave this up to you because you are an adult. But the whole idea here is you want to save a little bit of money or a certain portion of money. And once you save that money, you can reallocate the savings to your investments. Because your investments are where your wealth is built. Your savings are there to protect you against an emergency or make a big purchase or buy an investment, but you don't want to just save your money to save it.
Not rich.
And your investments are where the wealth is built. And that's what we're going to be talking about in part 3 is how do you invest your money? How do you put your money to work? Which brings me to the topic of now, if investing is where wealth is built, how do you find great investment opportunities? Because there's a lot of different strategies on how to invest. You can invest your money as an active investor, which means you're looking for good investment opportunities. You can invest your money as a passive investor, which means that you're just going to set up a system and you can set it and forget it. But if you really want to build more wealth quicker, well, if you can find a good investment at a discounted price, that means you can buy more of that investment with the same amount of money, which is where knowing how to find that investment opportunity is so important. And history, while it doesn't always repeat itself, it does rhyme. So let's talk about how you can find the best opportunities to make the best returns. And the way that you do this is, well, poop, P-O-O-P. I talked about this on YouTube one time as well. I mentioned it only one time. But if you've heard me talk about the poop method, give me some guac. That way I know kind of where we are in this investor summit. But let's jump into the poop method of finding opportunities. And what poop means is panic leads to overselling, leads to opportunity, leads to profit. And what that means now is what we've seen happen, especially over the last just over a couple of decades, is we have seen our economy go through the same cycle in different asset classes again and again and again, which indicates that we could see another opportunity in the future. And here's what poop looks like in action. Well, let's start by talking about the 2000 dot-com bubble bursting. And I'm going to be very honest here. This was before I was old enough to start investing. I was 9 years old when in 2000. So I really had no idea what was happening. But what happened in the 2000 dot-com bubble bursting was leading up to 2000, there was a lot of money going into dot-com companies, internet companies. And if you had a business with the word .com at the end of it, you were able to go out and raise millions of dollars. And you were seeing the stock valuations of these companies skyrocket, which created a massive bubble because now you had all this money going in, you had all this debt going in. And when you have more debt and more money and people not necessarily knowing what they're buying, well, that can create a bubble. Well, here's the first two parts of the poop, which is panic leads to overselling. In the year 2000, that was when investors started to see, oh no, maybe we overpaid for these investments a little bit. And maybe we need to sell off a little bit, which created a little bit of panic. And the little bit of panic, the little bit of downturn, because I had all these people buying .com companies who might have had no idea what a .com company is, starting to sell. And when they started to sell, people started to panic more, which caused the media to come in and say that the world is ending for .com companies. In fact, there were news articles literally coming out and saying that this internet thing is a fad. People have given up on the internet. No one's going to be using the internet in 20 years. Daily Mail published this famous article talking about how the internet is a fad. You can go check that out after this if you want. But it shows you that panic leading to overselling, because then when people started to panic more, they started to oversell more, which also created the next O and the second O and P here, which is opportunity. Because investors who came in were able to buy .com companies for a huge discount. Actually, just read the CNN article. You can see that NASDAQ was off 68% from its high.
That's crazy.
Which means, oh, the mic is a bit off. All right, how's that? Better on the mic side? The NASDAQ fell 68%, which means that now you could come in, buy something like the NASDAQ, and you don't even have to buy the individual companies. You could buy ETFs. And investors were able to come in, buy it at a great price, and make huge profits. If you are patient, which is a P that I didn't include in poop, but you have to be patient and know how to find those good opportunities. When I'm going to talk about how do you analyze investments in number 3. And what about 2008? Now, leading up to the 2008 crash was a lot of things that happened. You had ninja loans, no income, no job, no asset loans, which essentially means that, hey, I don't have a job, I don't have any money in the bank, but I want to buy this $300,000 loan. Is that okay? Well, banks would say, sure, just sign your paper here. Now you might say, but I don't have a good credit score. I've been behind and I've declared bankruptcy. They'd say, no problem. We have this new program for subprime credit loans. And then you might say, well, I don't have any money for a down payment. Is that okay? And then banks would say, no worries. We have a 0% down payment program. In fact, we will give you 110% loan. That way we can cover your closing costs and buy you a brand new TV, which created a big bubble. A lot of money flew into the housing market. And it wasn't just on the consumer side. You also then had Wall Street gambling on the investor side of mortgages and mortgage-backed securities, which then created the ability for this bubble to be formed. And the bigger the bubble, the bigger the burst. Well, we had a lot of money going in and a lot of
We in a
debt
big bubble right
in the
now.
housing
I
market,
ain't even gonna
which
lie.
then created the P. Because when the bubble popped, when people realized that, oh no, this isn't sustainable, when interest rates started to go up, well, that created a shift in the housing market. And we saw home prices fall. And this is an 18% drop in just 1 year. Well, in some areas, our office is in the Metro Detroit area. And in some areas, like in Michigan, where Ford and GM and Chrysler were either bankrupt or on the verge of bankruptcy, well, our economy was hit extremely hard. And that meant
Yeah, if
that
I
home
would be
prices were
doing
extremely
this
hard.
when,
In the
when
Michigan area, Southeast
2008
Michigan
or even
area,
the
you saw home
2020
prices were
crash,
selling in
bro.
some instances 90%
That's
off.
all right though, because I'm waiting for the next one.
But that
Bubble
also
burst.
created opportunity. Panic leads to overselling. And in this case, the overselling was foreclosures happening. It was a forced overselling. You do see this in the stock market as well, not with foreclosures, but with margin calls, because when people buy stocks on debt, which is called margin, what you'll see happen is if that stock value falls and you're underwater, the bank might force you, your broker might force you to sell. So now that leads to more overselling. You have the voluntary overselling of people panicking, and then you have the forced overselling, which is your broker, your bank forcing you to sell, which also creates opportunity. And that opportunity is now you can come in and buy an investment at a discounted price, which then creates the ability to make a profit if you're patient. And I'm going to give you a little story about this because by this time I have, well, gotten involved in investing. This was my first ever investment that I purchased. This was in 2011. It was a small,
Condo.
about 1,000 square foot condo, 1 bedroom, 1 bath. And it
sleep
was
on the
listed on
condos. I've been
sale
looking
for
at some condos, too.
$8,400. That wasn't the down payment. That was what it was listed for. And I made an offer to purchase this condo for $4,000. Now I'm going to reiterate this. I was 19. I had no idea what I was
19
doing.
years old.
I had never invested in
$4,000
real
buying
estate
a condo.
Nobody in my family is a real estate investor. I didn't even know that you could invest in real estate until I read a book called Rich Dad Poor Dad. So I had no idea.
Damn. Rich Dad Poor Dad.
Like when I say I had no idea, like I literally had no idea. I was
Oh,
studying for the
y'all,
medical
we
college
in
admission
this
test to get
big.
into medical school.
Rich Dad Poor
And,
Dad.
Well,
Read it.
I saw this because, well, I was
Read it.
researching what was going
Whoever
on in the
comments right
financial
now,
markets.
I'll
I was
send
actually
this
on
to you
Yahoo
so you
Finance,
can read it.
interestingly, looking for investment opportunities. And this came up for $8,400. I ended up purchasing it for $8,000. I put in $4,000 worth of work. My total cost to purchase this was $12,000. But I forgot to put this here. The craziest thing, true story, I can't make this up. Just a few years prior to me purchasing this condo, the previous homeowners or condo owners bought it for $150,000. And then they couldn't make the payments, so the banks foreclosed on them. And it went through the process for so long that the bank just wanted to get rid of it, which is why they listed it for sale for $8,400. So I bought it out of foreclosure for $8,000 after it was selling for $150,000, just like in 2004 or 2005. Bought it $8 grand for 2011, and then I ended up renting it out for $600 a month. And this is how much I rented it out back in 2011. I still own this condo. Rental values have obviously gone up. The value of the condo is, I mean, more than 10 times what I purchased it.
Exactly. He was 19 years old.
POOP. Panic leads to overselling, leads to opportunity, leads to profit if you are patient. And kind of another, I'll give you another funny story. And this is kind of a dumb story, but a funny story at the same time. To show you how ignorant I was when I started getting involved in real estate. I didn't have the most money. I was making money because I was running an event planning company. It was essentially hosting parties in college. I was a party promoter. And then I got involved into a little bit more sophisticated things. It wasn't even that sophisticated. I was hosting like some small concerts and some small like official after parties and shows when I was in college. So that was the money that I was making to buy these properties. I didn't have a ton of money. And a lot of my friends, there was people who had richer parents and they had way more money than I did. And I would tell them that you guys should go out and invest in real estate. And everybody was like, no, that's a horrible idea. You got to stay away from real estate because everybody's losing their shirt. And the interesting thing was that was the perception. You might look at this today and say, this is a no-brainer. I talked about these types of deals with other people then, and everybody was like, this is the dumbest thing that you could do to go out and buy real estate like this because everybody was losing their shirts. And everybody was saying, this was the sentiment, why would you want to go out and buy real estate? Because people will not want to own real estate in the future. You're never going to be able to sell your property. It sounds crazy, but that was the sentiment then. You get into this emotional fear, panic state, and the whole media. Like the media gets into this business of just selling hype and emotion of how the world is going to end. And I was, I guess, fortunate enough that I was ignorant to not really understand how the system works. But the funny thing is, I remember then in 2012, 2013, home prices started to go up. And I remember I was looking at homes now for about $30,000. We're talking about 3-bedroom, 1.5 bath homes in good growing areas, nice neighborhoods that would have rented out for $1,000 a month. And I started to look at these homes, and I did buy a number of them. But the first time I saw them was this interesting experience, because I was like, who in the world, who in the right mind would want to pay $30,000 for a 3-bedroom, 1.5 bath home in a growing area? What a ripoff. What a, like, this is way too much money. And it's hilarious now because I remember this mindset when I was 20 years old, 21 years old, looking at this, like, why would I want to pay 30 grand? Like, I should be paying $20,000 to $25,000. That was the mindset then. Now, obviously, I've become a little bit smarter since then. But understanding when that panic is happening, when the emotions are happening, you got to be willing to go against the traditional kind of sometimes news and kind of the grain, because the majority, I don't know how else to explain it, but the majority, when it gets in like this mindset, everybody assumes that this is how the world works, but the people that really build wealth are the people that are going against the grain.
Exactly.
Let me give you one more example.
Listen to the news.
2020. Now, before I go into this one, I want you to think about, well, what did you do in 2020 when the markets crashed? Were you buying stocks? Were you selling? Were you watching? Were you scared? What was your general kind of mindset towards it? And be honest, it's okay. Whatever it was, it's okay. Because our goal here is to talk about how you can build your wealth and how you can build your mindset and build your financial education. So when the 2020 pandemic happened, leave me a comment with what you were doing. So Jordan said paid off debt.
Tune in, man. Learn what to do with your money when the next crash comes.
Someone was saying buying oil ETFs, nice. Ivy was holding, paying off debt. Rodrigo was selling. Some people were scared, paying off debt, learning, holding, hanging on, no financial education, paying off debt. So you can see, well, this is another once in a lifetime opportunities. And going back to poop. Why does poop matter? And I made it poop because I hope that would be easy to remember. But panic. We remember the panic for 2020. This was not that long ago. So it's either very easy for us to remember the panic here, which was everybody saying the world is going to end. Everybody was saying, why would you want to buy stocks? Everybody was saying that the whole economy is over for, which created overselling. And this overselling was in the form of, number one, people selling off their investments. And number two, the overselling was in the form of people saying, I don't know what to do. My stocks are down, and brokers now calling in margin. Because if people had debt in the stock market and seeing their stocks go down, they were forcing people to sell, which created, again, a huge opportunity. Because not only did we see the stock market fall at the fastest rate ever, we saw the fastest 30% or 35% drop in the history of time, but we also saw the fastest stock market rally in the history of time, which, well, I didn't expect that to happen. I work pretty heavily in finance. Like, I am an investor. My whole company, Briefs Media, is in the financial news and education space. My YouTube channel, my show, Minority Mindset Show, is all about finance. I study history a lot, but I had no idea to what extent the Federal Reserve Bank and the government was going to stimulate and inflate our economy and the markets, which caused our markets to go at record speeds, even though we were in the worst, supposedly, recession since the Great Depression. And let me tell you about this one, because during the 2020 pandemic, I was on YouTube. And so I got to experience, well, the emotion in this from the media side for the first time ever. When this crash was happening, you saw stock markets fall at the fastest rates ever. And I was making videos. I went from making about 3 videos a week to videos 7 days a week when the market shut down, when the economy shut down, because the economy was flipped upside down. So I started making videos 7 days a week. And during that time, I was talking about how I was buying stocks on the way down. I was buying stocks in phases. I had no idea how bad it was going to get. I had no idea when this was going to end. I had no idea to what extent COVID was bad or serious, or the pandemic was going to be bad or serious. I had no idea. But what I did know from history is that, well, eventually things will probably recover. If they don't, we'll all be dead or something, right? I mean, it's like, I know from history things will recover. In 2000, everyone thought that the internet game was over. In 2008, people thought that no one would ever own real estate again. In 2000, people thought that no one would ever spend money again. My thinking was, well, I think eventually that people will spend money again. Otherwise, well, world will never be again.
Right.
And so I started talking about how I was buying in phases. And the comments that I was getting was people flooding me saying, JAHSPREET, you're out of your mind. Why would you be buying? The world is ending. You wait till the market collapses. This whole thing is over. Why would you want to be buying? And I was inundated. And I mean like inundated of people who seriously believed that there would never, ever be the opportunity to make money in the markets again, that this was the end of our economic system. Again, there's a lot of fear in the world. Fear sells. And this is where, again, you got to be willing to go against the grain. POOP, panic leads to overselling, which leads to opportunity for the minority mindset thinkers that can go against what the majority of people are thinking, which then leads the opportunity to profit if you are willing to go against the grain. This is a chart of the S&P 500 over the course of just about a year. The S&P 500 is the 500 largest companies in the stock market. You can see the massive crash between March and April of 2020. And over the next year with the money printer coming in, well, now we're breaking brand new record highs, which means you have to know how to invest your money the right way. You have to know how to find the opportunities, and you have to be willing to go against the grain. And that also means that we'll also see more great investment opportunities to come. Now, if you're with me so far, give me some more guac. I know this has been a lot. I'm going to take a quick sip of water. If you're with me so far, give me some guac if you feel like you're getting some good value out of this investor summit. And Christian, great comment. Poop is the new be fearful when others are greedy, be greedy when others are fearful. All right. Oh, yeah. The guac is coming in. Oh, baby. I love it. Now, the reason why we know there will be another once-in-a-lifetime opportunity is because the things that have caused these bubbles is generally debt, overbuying, and the fact that our economy goes through booms and busts, our economic system. And it's not just the United States. This applies globally. So if you're not in the United States, understand this happens around the world. Is our economy goes through booms and busts. There are periods where our economy goes up. There are periods where our economy goes down. This is a fact. This has happened as long as modern history has happened, that you go through these periods of economic booms and economic busts. And in fact, we've seen a recession pretty much every decade for the last century. And the longest period the United States has gone without a recession, does anybody want to guess? When was the longest period that the United States has gone without a recession?
2008 to 2020?
In the last century? Put your comments in the chat. I'm interested to see
2008.
When this was. If anybody wants to put a guess in there for that. Still got the guac coming in. I love it.
2008.
All right. So we got the comments coming in. Some questions right now. 2008, 2020. Yeah, there we go. Okay. A lot of people are.
Hey,
great.
I'm using the chat.
Yeah. The longest period
to 2020
that the United States has ever gone without a recession was after the 2008 crash and before the 2020 pandemic.
Come on, man.
And the interesting thing is the 2020 pandemic was essentially a forced recession. And this isn't a political thing. It was the economy that was shut down, which caused the recession to happen. And in 2019, before the 2020 pandemic hit, we were close to a recession. How do I know that? Because in 2019, the Federal Reserve Bank cut interest rates 3 times. They cut interest rates to stimulate the economy, to put more money into the economy, to create a more economic boom. So in 2019, our economy was already starting to slow down. We had issues. I'm an investor in startups. And in 2019, there was this huge shakeup in startup investing because interest rates were higher. Less money was going into the startup investments. Valuations were falling. So people were worried about this recession. That was when the Fed started to kind of save the economy by cutting interest rates 3 times in 2019. And then the pandemic hit, and then everything got flipped on over its head. So now we talk about, well, are we going to see another opportunity? Absolutely. No one knows when, but let's just take a look at what's going on. In the year 2020 and 2021, the government spent about $5 trillion in stimulus. And I'm not even talking about the Federal Reserve Bank quantitative easing. We talked about $5 trillion worth of stimulus. And don't forget that our economy is about $25 trillion big. So the government spent about 20% of our entire economy. It takes 365 days of our entire economy, people and businesses to go to work to produce $25 trillion. And the government essentially printed 20% of that with the click of a button and injected it into our economy. So that's a lot of money going into the economy. But that's not all. Don't forget that now, over the last 18 months, the Federal Reserve Bank has been working to increase interest rates to the highest level in more than 2 decades. And this happened in a span of 18 months that we've increased interest rates by over 5%. But that's not all.
Keep going up.
Don't forget, this is from the last couple of weeks. Moody's downgraded banks. 10 banks. And now they're warning of other larger banks, about 6 other larger banks that they could potentially be downgraded as well. Moody's is one of the 3 largest, or the 3 major credit rating agencies globally. But that's not all. Fitch, this is also from August. This is August 1st, 2023. Fitch downgraded the United States from a AAA rating down to a AA plus rating, which shook up things in the bond market and the economy. The last time that we saw this happen, that the United States was downgraded, was back in 2011, after the Great Recession, after we had the big debt ceiling crisis back in 2011. Well, this just happened in August of 2023. And we have all the issues in the global economy. This was actually from today. Russia has been going through a lot of issues. Their currency is plunging. And it's not just Russia. China is going through their own economic craziness. So you have issues going on in the global economy, which impact the United States. And we have issues here in our own economy, which leads me to believe that, yeah, we will see more opportunities in the future. And the people who can capitalize on them are the people who understand poop, but the people who are also financially educated. Because my thinking, like we've seen happen for the last number of decades, is if we go through some economic pain at some point in the future, I'm not saying this is going to happen tomorrow or next year, but at some point in the future, when we go through more economic pain, there's a chance that more inflation will be created, whether it's through cutting interest rates, whether it's through stimulus, because that's what happened in 2008. The Federal Reserve Bank cut interest rates and they created stimulus checks and other stimulus programs to bail out businesses and to give money to people. In the year 2000, we also saw cutting interest rates and other stimulus programs to stimulate the economy. All these things created inflation, which benefit the investors and the business owners, which is why, again, that financial education is so important. And on the financial news side, this is also why it's so important to read real financial news and to avoid emotion, because the reality is, man, a lot of the financial news is in the business of selling emotion. Now, I'm going to give you another just honest moment here. I've learned this the hard way because I am on YouTube. And I'm sure you've seen it, but some of the titles on YouTube, including my videos, can be very emotional. And the reason why is because if they're not emotional, nobody clicks on them. We've experimented a lot on my channel with different types of thumbnails and titles. And unfortunately, the reality is we've tried making videos that are like, here's what's going on in the economy versus economic craziness. Well, people click on the economic craziness one. And this was a very tough talk for me, which was with my team, where they said, look, we believe you put out real financial education. If it takes a more, we'll call it clickbaity title to get somebody to watch it, at least they'll get some real financial education. So even on the financial education and the news side, I'm just being completely honest here. If you don't have a clicky title, nobody will ever watch it and it'll go into the internet graveyard. But the reality and what I want you to understand is don't judge things based off of the title. Listen to the education and look for real education. Avoid the sensationalism and look for, the real education. And that's one of the things we're doing at Briefs Media. Yes, thank you guys for shouting out Market Briefs. I appreciate that. That's what we're doing. And by real news, what does that mean? That means now actually understanding what's going on, cutting through the emotion and the actual what's happening in the world. All right. Coming to the end of part 2. Now let's get into the real meat of things. Here's where we are right now. We've learned that our economic system benefits the financially educated. Financially educated means you are an investor. You're owning a piece of the assets. You're owning a piece of assets because now as an investor, you own a piece of the economic system. And that means you get to benefit from inflation. And that also means you get to benefit from the tax code. Now, the second thing that we talked about is using your money systematically to invest and save first. That's what we talked about here. You want to always put some money aside, whether it's 50, 30, 20, 75, 15, 10, to build wealth first. And now, if you want to take advantage of the most opportunities, you have to understand the poop method. You have to understand how panic creates opportunities, which leads to overselling, which leads to the ability to profit so long as you are patient as well and you're willing to go against the grain. All right, I'm going to take a quick sip here. If you're ready to go into now part 3, give me some guac, baby. All right. I love the comments. Pay yourself first. Francisco put some guac in there. Samuel gave me some guac. Edward gave me some guac. All right, I love it. I love the guac, baby. Let's go. Part 3. Now, let's put your money to work. Now, again, I'm going to be going through a lot of information. I'm going through a lot of this quickly.
Not you work for your money.
I'm going to give you more resources if you want to learn more, because I know there's a lot of information here. All right, let's jump in. I'm going to be focusing on the real estate and stock side. And I'm going to give you all a quick poll here. Where do you want your next investment to be? Would you rather it be on the real estate side, or would you rather it be on the stock side? I just published the poll. I want to see your results. Where would you prefer your next investment to be? And this is going to kind of help guide me on this. So we have real estate, stocks. Okay, real estate's winning. Oh, now stocks is catching up. All right. Just watching the results come in.
You got the
poll. Wow. Oh. It's actually pretty close. Real estate and stocks. Yeah, it seems like real estate a little bit more, but primarily
where you guys want to invest your money, drop it down in the comment below.
All right. Good. It's actually almost 50-50. Pretty cool. All right. Well, let's jump in by talking about the real estate side. All right. If you're ready to talk about real estate, let's get some guac. I'm going to take one more sip of water before we jump in because this is where it gets really fun. All right. I'm going to close this poll too. All right. Jumping in on the real estate side of things. The reason why wealthy people love real estate is, number one, you get cash flow. Number two is you own a hard asset. And number three is you get tax breaks. And what I mean by this is when you go out and invest in real estate, the whole idea here is you're going to go out and buy a property, whether it's a single family home, whether it is an apartment complex, whether it is a mobile home park, whether it is a storage unit, whether it is a mixed use building, whether it is an office. You're going to buy this property. And the goal is not to sell it for a profit. The goal is to generate cash flow. That's why I invest in real estate. And I can only tell you about what I do. My goal is to buy a property. And then the rental income, I wanted to pay for my property taxes, my insurance, my maintenance, my management fees, my vacancy costs, and then if I have any debt, to cover that debt, and then put some money in my pocket every single month. That's the cash flow side. That's how you do real estate the right way. The second reason why I love real estate is because you own a hard asset. When you own real estate, you own something that you can see, feel, and touch. I mean, you can see the bricks, you own the windows, you own the roof, you own the actual plywood, you own the bricks, like you own everything in that property. You own a hard asset as opposed to something like stocks where you own just a paper certificate, which says you own something. And the third thing is you get tax breaks. And as an attorney who is not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that our tax code has to offer. And what that means is now you can generate income and you could potentially pay little to no money in taxes because one of those tax breaks is called depreciation. And what depreciation says is that my property is 1 year older. And because my property is 1 year older, I deserve a tax write-off, even if your property goes up in value. So you saw that condo that I owned. You saw I own different types of real estate. Every single one of these real estate, I get to write off this depreciation deduction against my taxable income. So if I made $10,000, I could write off $2,000, $5,000, $10,000, just depending on what the property is. I'm not getting into technicals yet, but I'm going to write off a piece of that would pay less money in taxes. So I might only tell the IRS I made $5,000 worth of taxable income, even though I have $10,000 in the bank. That's part one, the depreciation. Part two is you get to write off things like your ordinary and necessary expenses. Well, guess what? If I need a cell phone to manage my real estate, that's a write-off. If I need to buy meals with my property manager, my property contractor, that's a write-off. If I need a truck to get to and from work, that's a write-off. If I need to go to Hawaii when there's not a fire going on to look at some real estate, that's a write-off. Now, little disclaimer, make sure you have a good accountant here. Make sure you have a good accountant here. I cannot emphasize this enough because, well, a good accountant can save you a ton of money in taxes. A bad accountant's it might be cheaper, but they're going to end up having you pay way more money in taxes because the tax game is literally a game. And you need somebody who understands the rules of the game. And the second part to it is, well, if you own real estate, you can sell it for a profit, assuming you own it for longer than a year as an investment and pay $0 in taxes today because they have something called the 1031 exchange, which means if I bought a property for $100,000 or the $8,000 property that I bought, and then I sell it for $100,000, that's a lot of profit. We're talking about over $90,000 worth of profit. It's a big taxable income. But if I take all of the $100,000, I go out and buy a bigger property with bigger cash flow, and I do it the right way, I can pay $0 in taxes today. You can't do that anywhere else except real estate. It's called a like-kind exchange, 1031 exchange. And now you can do that again and again and again, as long as you hold on to the property for at least a year. And if you do this until you die, you never have to pay you never have to pay a penny in taxes on that income. That's why wealthy people own real estate. And this is where a lot of people hear about this topic of no money down real estate because, well, real estate is expensive, right? Well, I'm not going to lie to you. Real estate is expensive. If you heard about no money down real estate, give me some guac. But let me be very honest with you about no money down real estate because I'm not here to lie to you. Look, the way that I say it on YouTube is I'm not here to make friends. I'm here to help you be financially educated. If you want to invest in real estate, you do need money. You need the right team. You have to be willing to fail. But you do need money. And let me tell you something about no money down real estate. I love no money down real estate, but not the way that you think. Let me show you why. This is a no money down real estate deal, and this is a 100% true story. Here's the guy, I don't remember what his name was, standing in front of this property saying, on this page, saying, look at how I own this apartment building, how I bought it with none of my own cash. I closed it in 87 days flat, and I'm making over $3,200 per month of positive cash flow. Well, let me tell you a little bit of backstory on this. This is a 20-unit property. His purchase price for this property was a little bit over $1 million. It was like around $1.1 million. He had 3 different lenders on this properties, on this apartment complex. 3 different loans.
Don't sleep on them hard
0 money down. Also, 0 financial education. Well, guess what happened? He didn't know how to manage the property. He also didn't know how to manage the debt. And then the lenders, when he wasn't making his payments, wanted the property back. There's your no money down real estate when you don't know how to do it the right way. And then he foreclosed on the property, and that was when I was able to come in and buy this property from him at a huge discount.
What?
This was a guru selling this. The reason I know the sales pitch is because he was selling a program on how to buy apartment complexes and generate cash flow for, I don't even know, probably $997 or whatever it was. I don't know the exact price, so don't quote me on that. But this guy was selling this program and how he was doing it, and he was marketing this program with him standing in front of this building. Well, then he got foreclosed on this building from his 3 lenders. His 3 lenders were so desperate to sell because now there's 3 people, 3 different banks that wanted their money. And he was struggling. I don't know what he did, but this property then became dilapidated. People were not paying. And so they wanted a buyer. They had a buyer in contract. The buyer backed out of the deal, which is why then they came to me. And I was able to negotiate this. I bought it for $425,000. This was the homepage of his website for him selling his program. I bought this for less than 50 cents on the dollar from him. I put in about $100,000 worth of renovations. And then I was able to generate about 16% returns.
He purchased that
cash
for $1 million.
This wasn't just like the economy went down. This was somebody didn't know how to manage the deal. They didn't know how to manage the debt. Yes, the economy, I'm sure, had a factor with it. But this is where, yes, no money down real estate works for some people.
Came up.
But you have to
imagine
know
how much that's
how
worth
to
right now.
manage
he had
your real estate as well.
One little
And
condo.
if you want to win in real estate, you do need money.
It right now.
Okay, plain and simple. If you do not have money, real estate is probably not the best place to start. You got to get the money first that we can invest in real estate. Are there ways to get started in real estate without money? Absolutely. You can go out and do syndicate deals. You can go out with syndicate deals. Essentially, you go out and raise money to go out and buy another property. That way, now you're not putting in all of your own money. You can also go out and invest in something like crowdfunded real estate deals. You can invest in other people's syndicate deals. If you go to any real estate investor conference, you will see investors trying to raise money, developers trying to raise money. It's just everybody's trying to raise money in real estate, and you can give them smaller sums of money, and now you invest in them. That way, now you let them manage the money and hopefully grow the deal. So yes, there are ways for you to get started in real estate with less money, but if you want to actually own property, you got to have some money. Okay, plain and simple. I'm not here to lie to you. I'm here to tell you the truth of how it works. Now, you also have to know your goals when you invest in real estate, because I have a few goals when I invest my money. And the number one goal for me is I want to invest in stable and growing neighborhoods. And the first question everyone says, well, how do I know if a neighborhood is growing or stable? Look at the population.
You want your best ROI,
Google makes this very easy.
Cash flows coming in that property.
Just go to Google, search the population of a neighborhood, a city, state, whatever, and it will tell you the population, and it'll show you if the population is growing or stable. I like to invest in cities or neighborhoods where populations are at the very least stable or if not growing, because if populations are growing, that means demand is growing, and if demand is growing, that means there's more people that want to live there, and if there's more demand, it means I can also raise my rents in the future.
What to do with your money, so how to make the money work for you, and not you work for your money.
The second thing I like to look at is where businesses are moving to, and the question here is, well, how do you know where businesses are moving? Let me tell you very quick, because there are research reports that you can pay thousands of dollars for.
Buy a property
investors will pay tens of thousands
and where businesses are moving
of thousands of dollars to get this type of information to find where money is moving.
But I'm growing like crazy.
I'm going to give you a simple test that way you don't have to pay all that money to figure out
by the day. And I work in construction.
Here's what you do: go to a neighborhood where you're considering investing, and go to a local coffee shop, buy a cup of coffee, talk to the barista, and ask them, "Do you live here?" If they say yes, ask them, "How do you like it?" If they say no, or I don't like it, ask them why. If they say, I love it here, all my friends are moving here, there's so many restaurants and bars moving in, well, that's a good sign. If they say, I hate it here, there's so much crime, businesses are moving out, you know. If the barista says, I don't want to live here, or I don't live here and I want to live here, well, that's going to give you another sign. If they say, I don't live here, but I want to live here because there's a bunch of restaurants coming in, good sign. If the barista says, I don't live here, I don't want to live here, bad sign. It's a $5 test, but I want you to up it to $20. Okay. Even if you don't have a lot of money, you got to be able to have $20 to do this coffee cup test. Go to 4 different coffee shops, talk to 4 different baristas, talk to a few different people, and ask them how they feel. Smart. And that's going to give you some behind the scenes information about where businesses are moving. I have made a lot of money from this. This is not some rocket science secret. I talked to people. I talked to the city hall one time, and they told me that this vacant building was going to be bought out or was in contract to be turned into a Walmart supercenter. They'd already bought it. It hadn't hit the news yet. So what did I do? I started buying real estate, the properties around the Walmart supercenter that was yet to come because, well, it was like a dilapidated building. And I was able to see not only property prices go up, but also demand go up because when Walmart came in, we saw dozens of smaller businesses come in because they brought in so much traffic.
The
money
too.
meant valuations went up, but it also meant the rental prices went up.
In there too.
The third thing is, what is your cash on cash return? For me, I like a 7% cash on cash return. That is generally what I'm looking for. Cool. Is it harder today? Absolutely. But listen, today's real estate market isn't going to stay like this forever. Real estate markets go through cycles. In 2011, it was a buyer's market. Today, we are a seller's market. We will go through cycles. This is a part of the economic system. The real estate market has its own cycles. It's a part of the system. And so for me, I'm not trying to chase real estate deals. Right. I'm looking for deals that meet that return. Can I find that return today? Yes. Does it take more work? Yes. But I also understand that I don't want to chase deals. So understand what types of returns you're looking for. And also understand that different parts of the country, different parts of the world are going to have different types of returns. Manhattan and LA have lower returns. If you look in the Midwest, you got higher cash flow returns. When I was looking for real estate in Austin, this was last year or about 18 months ago, they were selling properties for what's called 1 cap, meaning 1% returns. Meaning if I put $100,000 into a property, I would make $1,000 of income over the whole year.
That right there.
It's not enough for me. Crazy. Well, some people were buying because they were thinking, man, I'm going to sell this property for double the amount of money in a few years. That's not my goal. My goal is cash flow. And so this is where you have to understand what your goals are as well.
Long-term cash flow.
So 7% cash on cash return means if I invest $1 today, I'm going to get $7 of cash flow after paying for all of my expenses, after paying for my property expenses, after paying for my taxes, after paying for my vacancy, or if there's a vacancy, after paying for my management fees, after paying for my maintenance fees. I'm going to invest $1 and make 7 cents of profit just from cash, not from appreciation, not from property growth. 7% cash flow. So if I invest $100,000, that's $7,000 worth of cash flow from doing nothing except owning the property. If property prices go up, that's icing on the cake. If property prices fall, oh well, I bought it for cash flow. And that's what cash flow means. And this is where now you got to know your goals. It's going to depend on where you are. It's going to depend on your risk tolerance. It's going to depend on the types of things, the types of returns that you want. Some investors are okay with 3% returns. That's fine. Some okay. Some investors want 10% returns. That's fine. It's going to change how you invest and where you invest, but you have to know your goals. This brings me now, switch gears a little bit and talk about the stock market. If you got some value out of the real estate
who's in the
side
stocks,
of things, give me some guac as I take a sip of water, and we're going to jump into the stock market side of things.
Sleeping on the stocks.
And I'm going to answer a quick question from Patrick who says, will rents ever drop? Yeah, rents can go down too, which is why I like the 7% cash on cash return, because if rents drop, I also got some cushion to lower rents because I don't want to be in that situation where I can't lower rents. I want to make sure that I can. All right, we got the guac coming in. Oh, baby. I can't even read the names. I'm sorry. They're coming in so fast. I saw Erica, Kevin, and Angela. All right. I'm going to keep jumping in. All right. Why stocks? Oh, baby. Because when you invest in stocks, you own a piece of the economy. If you invest in a company, you are one of the owners of the company. If you invest in the Apple stock, you become one of the owners of Apple. If you invest in the Amazon Corporation, you are one of the owners of Amazon. Yes. You don't have to decide what to do. You don't have to work day to day in that company. But you get to share in the profits.
Cash flow.
You also don't have to be involved. Like you can own a share of Coca-Cola and never have to bottle Coke and own some of the profits, whether it's through a dividend, which is cash flow, or whether it's through upside, meaning appreciation, meaning if stock prices go up, you get some of that as well. Because guess what? Some companies pay out this thing called dividends, which is cash flow, which means you get paid for doing nothing except owning the stock. Whether the stock goes up and down,
that's why
up or down, you get paid that dividend. So you can be less involved and there's less capital. You can start investing in stocks with as little as $100, even $10, even nowadays $1. There are some platforms on the internet that will allow you to start investing in stocks with as little as $1. So it's not the capital that makes it difficult for people to start investing now.
Start today with $1.
Do you have the education to know how to invest in stocks? Because for the average person, for most people, this is what they think stock market investing looks like. I want to find the next Apple stock. If you've heard people looking for the next hot stock, give me some guac. That way I know.
Facts.
People are generally looking for the next Apple, the next Amazon, the next
Google,
mad
money on everything
the next
that's
Facebook or Meta. This is what people are looking for. They're looking for the next hot stock. What are we seeing? We're seeing, okay, we got the guac coming in. Sorry, it took me a second to see that. But you don't have to do that.
I'll show you my
Here's what successful stock market investing looks like for most people. You don't even have to try to find the hot stock. Here is an ETF, and I'll explain what this means. If you don't know what this means, it's okay.
Growth, my brother.
VTI, and I'm not telling you what to invest in. Remember my disclaimer, investing as risk. I can't tell you what to invest in, etc., etc. But VTI is an ETF, a fund that if you buy VTI, you're buying the total stock market. You're investing your money into the stock market. Now, you don't got to worry about trying to find the best company because you might think you know what the next hot stock is, or you might invest in the hot stock today. But the hot stock today might not be the hot stock in 20 years because guess what? 20 years ago, do you know what the hot stocks were? Bed Bath & Beyond.
That's crazy.
Sears. These were market killers. These were category killers. These were companies that were revolutionizing their industries. And people were buying them hard with their retirement money, thinking, oh yeah, I already know Sears is going to be around forever. How could Sears ever go away? Bed Bath & Beyond is everywhere. I love going to Bed Bath & Beyond. Where's it going to go? Well, guess what? They're bankrupt. And this is where now, if you're not willing to do the research, if you're not willing to keep up with the companies, that's okay. You don't have to. You can just invest in a fund that gives you exposure to the stock market or the S&P 500 or the Dow.
That's what I invest in. S&P
that gives you exposure to the markets without having to necessarily keep up with all of that, which is why you have to know your strategy. So again, you got to know your goal. For me, I'll tell you my goal. I can't tell you what to do. I don't recommend what I do to anybody, but I will tell you what I do because that's what I do. Number one, passive cash flow. What that means is I have a passive system, which is every Wednesday, doesn't matter what day you pick. I pick Wednesday because it's in the middle of the week, but every Wednesday, money leaves my bank account and it automatically gets invested into my portfolio of funds. And most of those funds are for cash flow, meaning dividends, meaning every week I buy more of these funds that keep paying me with cash flow. Every 3 months, every quarter, I get a check. Or it's not an actual check. It gets deposited into my brokerage. And I'm just buying more of the cash flow. So for me, it's passive cash flow. That's my number one goal. And again, I'm going to show you why this matters. And again, I'm not telling you what to invest in. Here's an example of a fund. Let's say you wanted to invest in ETFs that pay cash flow. Well, here's one. Noble is the S&P 500 Dividend Aristocrats ETF. Let me explain what that means. These are companies in the S&P 500, meaning these are one of the 500 largest companies in the stock market. So this is investing in large companies, one of the 500 largest companies in the stock market, and they're investing in dividend companies. Dividend companies are companies that are paying out cash flow, but it's not just regular dividends, it's investing in dividend aristocrats. A dividend aristocrat is a company that has paid out and increased their dividend over the last 25 years. So now, if you wanted to invest for cash flow, you can look for companies that have paid out and increased their dividend every year over the last 25 years.
Right, 7%.
Or you can invest in a fund that gives you exposure to a number of companies that invest into dividend-paying companies in the S&P 500 that have paid out and grow their dividend over the last 25 years. That's what this ETF does. So now it's a way for you to just passively invest. Again, I'm not telling you what to invest in, just an example of how these funds work, because if you invest in the wrong company and it goes bankrupt, you lose everything. But if you invest in a fund, well, now you can protect yourself with that downside protection, because if one company goes bankrupt, well, there's other funds that will balance it out, and this fund will kick out that loser and add in a new one. And no, I am not sponsored by Noble. It's just a recommendation. Not a recommendation. It's just an example. It's showing you how it works. I don't want to invest in Noble. Okay, just an example. The second thing you want to, or I invest my money for, is active growth. Active growth is now I look for individual companies to invest in that I believe are undervalued. Now, what does that mean? I'm looking for companies that I think are going to have a lot of potential in the future, that I believe have a high barrier to entry, meaning the companies have a hard time competing with them, which means I believe that there's going to be a lot of upside because they're innovating and the financials look good. This one takes the most work because now I'm researching companies fundamentally. I'm researching things like the cash flow statements, the income statements, the balance sheet. That way I can see the numbers and see, is the stock price undervalued or overvalued? So yeah, I like to be actively involved because that's something that I'm interested in. If you want to invest in individual companies, you want to be more financially educated and do that active type of research, because if you don't, well, now you're just gambling and speculating. The third goal that I have is I want to limit my risk, because when I invest my money, I don't want to lose. I mean, I know losing is a part of the process, but I want to limit my risk as much as possible. Okay. So let me give you a quick example. When I invest in funds, what does that look like? So going back to VTI, this is the total stock market ETF. A couple things that I look at is, number one is the expense ratio. If any of you have a 401k or IRA, let's start with that. Do you have a 401k or IRA? Give me some guac in the comments.
Yeah.
So if you invest in a 401k and IRA, any sort of retirement fund, give me some guac just so I know if that's something that you were already investing your money in. All right, we got the guacs coming in. If you invest your money into 401k or IRA, you're probably investing your money into funds. And guess what? Every fund has a fee. And this fee is called an expense ratio. See, if you didn't know that your fund was costing you fees, if you didn't know that your 401k was costing you a fee, if you didn't know that your IRA was costing you a fee, well, now you know. It's actually funny. NerdWallet, I believe it was, did a study, and they found that 91% of 401k investors didn't know what their 401k fees were. So if you have a 401k or IRA, I highly recommend you do this tonight after the Investor Summit. Look at what your expense ratio is, because an expense ratio of just 1%, which might not sound like that high, 1% means that if I invest $100 into this investment, they take $1 of fees. Well, if you start investing from 21 into retirement and you pay just a 1% fee, do you know how much that fee is going to cost you? Take a guess how much a 1% fee is going to cost you over the course of your investing career. Is it going to be 1%, 5%, 10%? Leave me a comment in the comments. I'm interested to hear about this.
Take 1%, then what?
How much do you think a 1% fee will cost you? Because that 1% fee is not just a 1% fee today. It's a 1% fee that will compound, not just on the money that you invest, but also on the money that your money makes. So it's a 1% fee compounding. So yeah, I'm seeing 1%, 30%, 28%, $500,000, 7%. That 1% fee is going to cost you around 28% of your total investment portfolio, which means if you can grow your money to $1 million, $280,000 is going to go to fees, which means, yeah, you're still going to have $700,000. But that 1% fee ate up a huge chunk of your profits, which is why you need to understand what your expense ratio is. VTI here, one of the things I like to look at is the expense ratio. VTI has a very low expense ratio of 0.03%, which means that if I invest $100 into this fund, 3 pennies go to fees. So it's much lower. Again, I'm not telling you what to invest in, just showing you some of the things that I like to look at when it comes to research. Another thing that I like to take a look at is the total assets under management. Here I can see that VTI has over $1 trillion in assets under management. And the reason why this is so important is because if something bad were to happen in our economy, which happens, bad things happen, you want to make sure you can sell. And so if there's not that much money in assets under management, that means that generally the volume of trading is low, which means if you wanted to sell because something was going wrong, you needed the money or whatever, there might not be a buyer. And you want to make sure that you can have that protection.
Alexa,
so one of the things I generally like to look for in assets under management is generally a minimum of $1 billion in assets under management, because, well, if there's less than $1 billion in assets under management, there's less volume, which means if something bad were to happen, I might not have a buyer, but I will make an exception. If I'm investing into more obscure places, like if I'm investing into a fund that's giving me exposure to companies overseas or something like that, I will sometimes go down to assets under management of a minimum of $100 million. But I don't go lower than that, because if a fund has less than $100 million in assets under management, there's not enough liquidity or volume that if I needed to get out, that I can get out.
Yeah, facts.
So you can make up your own rules here. But for me, when I look for minimum assets under management, I generally look for $1 billion in assets under management or less. But at the very least, I need $100 million in assets under management as well. So 2 things to help limit your risk. Just take a look at the expense ratio. Take a look at the assets under management. So now, what does it mean right now? Our system is designed to benefit the financially educated. That's not just the tax side, but it's also inflation. Inflation happens. It hurts the consumer, it benefits the investor, and it benefits the business owner. It means If you want to capitalize on this, you need to build an economic system that allows you to take advantage of building wealth opportunities in this economy. And the way that you do that is not just the poop method, but you also have to understand, how do you buy assets? What are these assets? Things like real estate, things like stocks. I personally like investing for cash flow. Maybe you do too, but you don't have to. That's just one of the things that I like to look for. But you have to know your goal. When I invest in real estate, I have particular goals. I have the 7% cash on cash return goal. When I invest in stocks, I look for either passive cash flow or I look for active growth. These are the things that I'm looking for. And if you want to lower your risk, one of the things that you can do is make more financially educated decisions. Know how to research real estate. Know how to analyze and underwrite the deals. Know how to research stocks. Know how to understand how to value companies. Know how to research ETFs and index funds and mutual funds. That financial education will allow you to lower your risk because, well, it's going to allow you to know more. And this doesn't guarantee that you're going to see any sort of success, but that financial education will allow you to lower some of the risks. I do want to give a little caveat here, because sometimes you can do everything right and still be wrong. Like there was a study, I think it was, I don't know if it was New York Times or Wall Street Journal, maybe somebody in the comments knows, but there was a study done where a professor or economist blindfolded a monkey and had him throw darts at a bunch of stocks and competed whatever stocks this monkey threw his money, the dart at, and competed those stocks against like money managers and hedge fund managers, and the monkey won. So yeah, sometimes you can do everything right and still be wrong, which is where, again, understanding that investing has risks, but when you have more financial education, that's going to allow you to make more money over the long term, because it's going to help you make more smart deals instead of just throwing your money emotionally. Because guess what? Everybody, myself included, has made these types of bad investments at some time in the past, and you want to be able to learn from them. All right. It's been a lot. If you got a lot of value out of what we have so far, we're not done yet. Give me some guac. I'm going to take another sip of water here. Oh, baby. What an investor summit. Okay. Oh, yeah. We got the guac coming in. Oh, wow. Amazing. I love it. All right. Well, let's keep going then. Now, the best education that you can get, I'm going to be, again, very honest with you. The number one best source of education is experience, going out and doing it. The best, I've read a lot of books on real estate investing. I've spent a lot of money learning real estate investing. But the best education that I had was going out and doing it, making mistakes. Same with stocks. I spent a lot of money learning about investing in stocks. Unfortunately. But the best education was going out and doing it. So I do not want anybody to think that you can bypass the education that you get from experience. Okay? Are you with me there? Give me, I understand. Give me some guac if you understand that you cannot bypass the experience. That is a crucial part of success, because without that experience, you will never be able to become wealthy. Can we be in agreement on that? All right, we got the guac coming in. You got to have that experience. But you can shorten that curve by learning, by investing in your education, by learning about how to invest in real estate, by learning how to capitalize on opportunities, by learning how to invest your money into stocks, by learning how to invest for dividends, by learning how cash flow investing works, by understanding history,